Thank you for coming in again. So give us just a few seconds so we can get Mr. Darrin together for you guys.
Thank you. So we have Darrin Wilson from Chase here. He's going to give us a great seminar today. Understanding and building your credit. We know credit, money, finances, financial freedom all together. All of those are powerful words. I know myself, I want to be rich. I don't want to work for anybody else. But saying it is one thing, but actually doing it, living your life day to day with that motivation of I want to get myself out of debt or I want to put myself in a better position, sending my kid to college, whatever your goal may be. So Darrin is going to introduce himself, tell you a little bit more about him, and then he'll be able to go right into the presentation. Are you ready?
Absolutely. Well, first of all, good evening, everyone. And I'd like to start off by just saying thank you to the Pay It Forward Networking Group for inviting me here this evening. It's an honor and a pleasure. But more importantly, I like to share information. So that's what it's going to be about tonight. You can see the topic there. It says understanding and building your credit. But before I begin into the seminar, a little bit about myself. Again, my name is Darrin Wilson. I'm the Vice President and Community Manager for JP Morgan Chase here in Delaware. A little bit more about myself. Now, I'm born and raised here, but I primarily worked as an investment consultant with Chase in Manhattan. So I worked on Wall Street. I've been working in financial services for the last 20 plus years. So what I'm talking about tonight and reaching out to the community and helping people change their behavior to change their life is something that I'm very passionate about. So we're going to get with it. I'm going to keep it informal because that's who I am. And we're going to talk about credit because credit is such an essential thing in life today. You know, we know about there's two things that are guaranteed in life. And what are those, ladies? It's death and taxes, right?
Yeah. I already know what you was going to say.
I'm gonna include you in the conversation while you're here.
No, I want you
But
to.
it's
I want to
actually,
learn something.
it's
tonight.
actually not just one, it's not two, it's three things. Credit is something that it is essential in our lives. You must have it to be financially free. You want to be financially free, as my sister here talked about. So you got to have good credit. So tonight we're going to go through that. But what I want to do is I'm going to read over some key points that I looked up. Now, in America alone, we're about $1 trillion in consumer debt across the country. $1 trillion. Understand that's a lot of money
Yeah.
for us to be in debt, and that's not a good thing. But right now, I'm going to talk about my people, African Americans, us, we in general, and give you an idea. 40% of Black Americans say they don't really have any personal credit or any personal credit cards. That's not a good sign because if you don't have credit, everything you do is going to cost you more money. If you have poor credit, it's going to cost you more money. To give you an example, if you're looking to purchase a home, if you're looking to purchase a car, if your credit is poor, that means that the lender is going to see you as a greater risk, so they're going to charge you more money, which is natural. Also, say the majority of Black people or Black communities, we have the lowest median credit score as compared to whites and Asians and some and Hispanics, if you look at that. So our median credit score is running around 600.
Hmm.
To buy a home with most organizations or most financial services or banks, you have to have a median credit score of 620.
Hmm.
Now that's still low to buy a house, but you can buy a house. The issue is you're going to pay more money.
Your interest would be higher.
Your interest are going to be higher. Now, among home buyers, people of color, like I said, how do we change that behavior? What do we need to do to change that reality? And that's something that we're going to talk about tonight because if you don't have good credit, as I said, everything costs more. It becomes difficult. If you have no credit, it's the same scenario. So we want to start looking at that. So here's a little agenda that we have today. It's just some of the information is going to be basic, and I believe you should already know it, but guess what? We're still going to talk about it because I'm sure there are people who will not know and have knowledge of what we're talking about. So understanding your credit score. Everybody should know what credit is. Credit is the ability to buy now and pay later. So if you look at a credit card, you're actually borrowing money that you're going to pay back at a later date. Ideally, you have to pay interest on what you bought. That's pretty much standard across any kind of financial product that you purchase that you finance. A credit score is an evaluation of your credit worthiness. Basically, what is the risk factor in lending you money? Credit report is a document provided by the credit agencies that tell you the history of your credit score. Or more important, it tells you what combines and what activity has caused you to have this particular type of score. And the credit bureaus, we know what they are. Tell me, do you know? We got Equifax, TransUnion. I'm waiting for somebody to speak up here. I don't hear the third one. Experian. There we go. There we go. So I'm putting these ladies to work here today.
That's fine, that's fine.
And we're gonna all learn from one another. And I'm gonna go through some of the slides and some of it that I'm going to skip over because I don't think it's that really important. But if you go back and think about credit, folks, I can't tell you how valuable. There are jobs that you will not get if your credit score is bad. You won't be able to purchase a home. You won't be able to rent an apartment. But if you do, you have poor credit, it's going to cost you thousands and thousands of more dollars. Versus if you have a good credit score, then in some cases you may have zero interest payments, or you just may have a very small one.
But Darrin, you know those scenarios too, where you have bad credit, but like somebody will still get a car payment at like one of those rinky-dink dealerships, and it's like the car is raggedy, your interest rate high, you making a high payment. Like there are people that will do big business with it, just won't be a good deal. So that's the other side of it too, right? Like not getting accepted, or you do get accepted, but then it's a bad deal all the way around.
Well, I have an explanation. I want you to hear. It's important. I'm not really going to talk a lot about it tonight, but everybody is aware of the 3 credit bureaus. But in truth, there are 35 credit scores. 35 credit scores. And to give you an example, how they break it down is that if you're purchasing a car, you're looking for a car loan, you will have maybe 6 different credit scores for that. But the range is different versus if you're buying a home. And see, the reason why you hear that commercial, no credit, bad credit, come on in. Well, the lowest credit score in which you could buy a car.
Buy your baby.
That's when you desperate.
The lowest credit score that you could buy a car is 250.
Okay.
Yes. That's the low. I understand. This is why they basically saying you almost have no credit if you're 250. Your credit.
I would think at that point.
But they will lend you money to purchase a car. Why? Because instead of getting it at 7%, you want to pay 14%.
Right.
So, you think about this. You buy a car for $40,000. You get a 5-year note, and if you get it at 14%, you'll wind up paying close to $75,000 for that car because all of that is in interest.
Yeah.
Now, if you had good credit, same duration, you may only be paying $45,000 or $50,000 for the car. So this is why you have to be very diligent about credit scores. And when I said there's like 35 different ones, well, there's a lot of different ones for buying a car, buying mortgage, personal lines of credit, credit cards, etc. I'm saying this is something that we need to learn about because this has an impact on who we are and what we're trying to do. There are 2 new credit scores that are very pertinent in today's world that most people don't know about. It's 10 and 10T. Now, the difference is that most credit, when you go to look at credit, they only look back 1 year. Now, with this new 10, it's going to have a further look back of 2 years. So they want a little bit more of a deep dive into your credit history for certain type of loans. 10T is more pertinent towards if you have health issues. And a lot of people are definitely struggling because, the insurance companies are not really covering us fully when it comes to our medical bills. So they're trying to be a little bit more lenient and more understanding, and that's why they have 10T. But we just have to look at how this new credit scores are going to affect this. But, excuse me, most people will not know about that because it's just not readily available. It is something that, excuse me, they created for banks. It actually generates more money for the agencies because the banks, they now want to use 10 to 10T and they have to pay for it. But at the end of the day, the financial services companies want to use it because now it's a deeper dive into your credit history.
Right.
Not 1 year, but 2 years and maybe 3. So just keep that little nugget in mind. Now, This chart here is probably the most important chart that I'm going to talk about tonight. It will explain a lot about your history. It has a significant impact on your history. I want you to take a look at that because we're going to talk about this. I'm going to spend a little bit more time on this than certain other subjects because this right here could change your credit score. This could change your life. This could put you in a position where you're not paying an excessive amount of interest on the loans that you may have. So we're going to start with what factors affect credit score. We know payment history. Everybody understands that. The most simplest thing to understand, pay your bills on time every time.
Now there is a little blurry, so can we say the percentage so people can?
Okay, I would say the gray scale represents payment history, which is 40% of a factor in determining your credit score. So payment history is, of course, you want to pay your bills on time every time. Here's a nugget that I want you guys to think about. Everybody knows a due date, but what about a statement date? Do we know what a statement date means? Oh, okay.
Yeah.
Now, the statement date is a date where the credit card companies, some, not all, but a lot, they report or do a snapshot of your credit and report it to the credit agencies on your statement date. Now, your statement date tends to be more of the first of the month versus your due date, which is on towards the end of the month or whatever time period that you're able to select.
Okay.
So what I try to teach is when you are living within your means, you have a budget, you know what you're spending. You want to be in the position that on the statement date, you want to pay your bills and have zero balance.
Yeah.
On your statement date, this will build good credit.
Nobody tells you that either.
No.
Because you know, when they send you a statement, they say due date, pay on the due date.
Pay on the due
Pay
date.
on the due date.
Now,
They don't say
understand,
anything about that.
every credit card is different. And the mistake that we make, and I say we because I've done it too, we've gotten a credit card and we don't read our contract. You get a new credit card, all you see is what's the interest rate, cash advance rate. You know, you're not reading the fine print. And that's something that we don't do normally. So if you read the fine print, see how what they say about that statement date and what it means for that particular card that you're utilizing. But at the end of the day, you want to pay off your balance on that date. So let's keep looking at that pie chart. So funny enough, I think the next most important one is not the 21%, it's the 20%. I spent a lot of time teaching some students about this today. This is the percentage of your credit limit that you use. At the end of every month, or say or at the statement date, or at least at your due date, you want to be 20% or less of your credit limit. So if it's $1,000, you want it to be $200 or less. Why is that?
Because it's going to impact your score.
It's going to impact your score. But the reason why you want it below that, because anything greater than that, they look at as a risk, as an increased risk. Now, 20%, 22% is not a lot, but a lot of people keep 50% balance on their credit card, or even more. They max it out. So what happens is every month, guess what? Your credit score is going to drop a point or two if you're above 20%. I can't really stress how important it is to stay below that number.
But it's so hard because like even when you think about today's economy, things are so expensive. Like even for me, I was out on Sunday last week, turned my key over, car wouldn't start, had to put it in the shop, $1,000, right? Not everybody has money just readily available, just laying around. So you put it on your credit card, but then the other point to that is it impacts you. So sometimes it's like a vicious cycle because life start happening and the washing machine go and then all this other stuff. And now you look up.
That's another seminar for another day that they can contract every year. But seriously, usually my very first seminar when I work with a group of people and I do a series, my first one is budgeting and savings.
Yeah.
Because I need you to understand, if you're a single person, you need to save 6 months or whatever your monthly expenses are.
Yeah.
First of all, you got to learn and figure out what that is.
Right.
And then you need to save up to that point. Now you could go 6 and you go 8, Now, if you're married, have children, or you're single and have children, you need to do 12 months or more.
So married, you said do more.
Well, they have higher.
Higher expenses because there's more people in the house. So.
Exactly. Now, why do I cut it off? There's a reason for it. The reason why I said you don't keep putting money into a savings account, which we would use as emergency fund, because savings account pays you a lower interest rate.
Okay.
Right. So again, you have to understand money has power. It's powerful on today's dollars. Now you leave it somewhere where it doesn't outpace inflation, the buying power weakens. I always use the scenario of when I was a kid and I was telling my age, I could buy a can of Coke for 25 cents. So we just fooled around one day and we calculated, well, if we put 25 cents for a can of Coke, I was a little kid.
What year was that?
I was a little kid, I don't know. I was a little kid. But because you could go to the store and buy the off-brand names in the supermarkets for 15 cents.
But the Coke, it don't taste the same now.
But it don't taste the same. So we said we put this money in a theoretical savings account over 30 years, and it only grew to about 75 to 80 cents. So guess what? My 25 cents could not buy a can of Coke in today's dollars. That's called the delusion of your buying power, meaning that inflation is eating away. So the reason why I tell people 6 months or 12 months and you stop, because I still want you to continue to save, but I want you to put it in vehicles that's going to outpace the rate of inflation. Now we're talking about utilizing money markets, investments. No, not necessarily, because we're talking liquid money now.
Okay.
This fund is addressing when life happens. That's what it's for.
Right.
Your car don't start. I know I was out somewhere, I got a flat tire, I couldn't plug it. They said $250. I don't care, I paid for it. Why? Because I planned for this.
Right.
Because I have my 6 months. I didn't have to use credit to pay for it. I used credit to pay for it, but guess what? Then I
You paid it right back.
right away.
So you can get the rewards.
That's another class that I teach. And then I really spend a lot of time going into budgets, how to create one, how to determine at the end of the month, am I running a deficit or am I running a positive? And then what do I do from there? But the most important thing is when you have a budget, you can now look at it and say, where could I extract money from? And it'd be like, instead of having cable, you go to the street. Instead of getting your nails done or your hair done every week, you do it every other week. Look at the nails. So there are ways. I won't talk about the women, but they're very costly. And the one thing I have to say is that Black women have the largest amount of debt compared to other nationalities. So, and there's a lot of other factors. And I will say this, racism and redlining and all these things are factors are earning in our credit. But we can do things to improve that state. But, I will see if they will invite me back and we'll have that discussion the next time around, because I think it's an important class, is what I normally start with. Because if you don't have this savings and this budget concept in place, anything else I teach is irrelevant. I can teach you how to improve your credit, but if you don't have money to do it, guess what? If you're living outside of your means, you can't pay your credit card debt. You can't pay any of the debt. But I can show you how to create your budget, see where you are, how to manipulate it so you do have extra money that you can pay down your debt. You can invest money, right? You can have a greater emergency fund. But that's a different topic for a different time, but I want to get back to our conversation at hand. So, the other one is age of credit or type of credit. But let's just look at age of credit. And one thing I tell people, do not get rid of any current credit card you have. The older the better, because that's how you establish a longer credit history. The credit agencies look at how old your credit is, because a new person, if you just had it for a year or two, we don't know really who you are yet. So the older you have a credit card, they have a historical data to reference with you. So you want to keep that old one. Now, it may not have the best terms, it may not have a great credit, and who cares? Spend $5 a month on it to keep it active, but never, ever get rid of it. It's almost like buying property, you never get rid of it. Okay, so those three are the main factors in what determines your credit score. And there's also available credit, which is similar to your credit limit. Because what they still look at is your asset to debt ratio. So your credit cards are considered an asset. Let's say if you have $25,000 in available credit on a credit card and you have $1,000 in debt, that's 25-to-1 asset to debt ratio. The greater that number, the better. So I tell people you don't necessarily need to get additional cards. What you need to do is get a greater credit limit. And you can ask them, say every 6 months, please increase my credit limit. So that way your available credit is stronger and it also gives you more room for that 20%.
Now what if they say no?
Well, then you want to know why. Because the only time they would typically say no is that the credit card is too new or your payment history is not great. It's because then, they still have access to other information. And one of the things you should discuss with them is that they need to update your profile. So say your salary changed. And sometimes they will just ask you, what's your current salary? Mm-hmm. What if you went from being unemployed to employed? Right. Or what if you went from being working for an organization to being a business owner and your income could have changed? So, or decrease. If it decrease, you may not want to ask for it, but those are the factors that they should have. So when you go to them, and I just did it recently, I said, you know what, it's time for a credit increase. So I called them up and I said, this is what I want to do. I told them something like, listen, I'm looking to continue to build my credit. I want to know what kind of increase I have. They said, okay, Mr. Wilson. Within 2 minutes, they told me what I could get. And I said, I'll take it. So that's why you always want to look at building a debt. And again, total balances is the same thing. We never want to be out of pocket, out of range in which we can't pay down our debt. The worst thing to do is carry excessive debt because it's expensive. It says that you're a greater risk, and it just will not help you become financially free. And one thing Nisha said, that's what you want to be. I'm not going to become wealthy. That's not my aim, but I want to be financially free so I can go where I want to go, spend how I want to spend within reason, of course, but live a comfortable lifestyle and not have debt. I think I've worked for many years. Right now, I'm debt free. It does kind of work against me because the credit card companies like you to be in debt. One of the things that's not going to be talked about here today is called credit mix. Credit mix is that they like to see you have a credit card, card note, mortgage, personal loans. Yeah. So they look at that as a holistic.
They want you to be in debt.
But they want you.
They give you that opportunity to jump right back.
It helps build your credit. Mm-hmm. But the downside is to us as consumers, why do we want to be in debt?
Right. Exactly.
Why do we want to be in debt? So it's funny how things.
But there's certain debt that. Can we say that there's debt that's good, like a mortgage?
All debt is good if managed properly. If
it's managed properly. Because the mortgage, that's an investment. Like we know that once this is paid off, this is generational wealth, like this is a tax write-off. So I think it matters what the debt looks like.
Of course. I mean, bad debt is that you charge your credit card up to almost 80% on items you don't really need. That's bad debt.
Like I just paid off my refrigerator. And they're constantly calling me to buy other items. I don't need them. I don't want to just buy it because you want me to buy it to open up more credit. I don't need them. I'll save for when I actually need it. Yeah. When I actually need it.
I'll share some stories about some things as we move forward. But one of the things about my son called me up one day and he was very, very upset. And I'm like, what's the problem? What'd you do? He said, yeah, I paid my car note off. I was like, man, that's great.
Paid it off.
He paid it off.
That's great.
But he said, "Dang, my credit score dropped." So I said, because that's the change in your credit mix.
Yeah.
Now, what will happen, and what did happen, over time, his credit score will improve.
Right.
But again, when we talk about credit mix, they like you to be in debt, and so he went from having a debt and paid off.
But that seems like a very flawed system. Like I paid my debt off. I think I should be rewarded for that. You penalize me for it.
You're thinking as a consumer, you're not thinking as a business.
Right. Because how does my business stay in business if I don't keep you in debt? If you make me in debt, how am I making money?
Everything's about revenue, profit. and they're in it for profit. So I understand it. That's why I said there are things that work with you, and there are things that work against you. And but it can have a little impact on your score. But if you do the other things that I talked about, the payment history, keeping your credit limit below 20%, keeping your old credit for credit cards, your score will still be well into the 700s. And once you reach the 750 plus, you're excellent. You have an excellent credit rating, and everything should be a little bit less expensive. So you looked upon very favorably once you reach. 600 is good, 620 you can buy a house, but once you cross that threshold,
700.
over and up in the
Up
700s,
to 700.
the lower 700s is good, but the 750 on up is
That's
excellent,
all.
and that's the target that you want to get. Because now, if you're trying for 800, it gets a lot more difficult. It's even more difficult to maintain once you get there. You can have that desire, but it doesn't have a significant impact on your overall credit experience in terms of the cost. But it looks good.
It becomes a status.
Yeah.
All right. So one of the things for you to understand what we're talking about is you got to understand the cost of having poor credit. And look at this scenario. We have two. We have poor credit. Remember we talked about that poor scenario. Then we got excellent, which they really take it into extreme because it's 781 to 850. Excellent is really starts in the 750 range. But look what happens. The poor credit has an interest rate of 10.5%, whereas the good credit has, let's say, rounded up at 4%. So your loan payment is, now this is on $30,000. Now your loan payment on your poor credit is $645 a month. And look how much it is if you got excellent credit. And look at what the total payback on the loan for the car. 38,000 versus 32,000.
That's a significant
Look
difference.
at the total difference. Right? We're talking $5,000 difference, man. That's $5,000 you can be doing something else with. So you can see the impact of poor credit. We're going to look at another scenario. Look at that. Look what happened. It cleared up on our end, didn't it? Don't ask me how that happened. That's great. All right, here we go again. Now, this is a $10,000 balance. But what's different is I want to go back again just to show you something.
Wait, Tim,
I'm sorry. The difference is the length of the loan. See, that's a 5-year auto loan.
right?
And I'm going to show you how the longer you're in debt, how much it costs you.
And cars
This
are
is
so
30
much more expensive now.
Listen, this is 30,000. Now look at this 10,000 one. This is 10,000 one, but look at the years that we are really looking at it now. So we're looking at, listen, it's a credit card. Interest rate is nominal, like 23%.
Right.
And certain ones, the better your credit, you get that lower interest rate.
Right.
I told
So
you.
they're not gonna offer you the 6 years for the poor
No,
credit rate.
For what? For a car loan?
No,
For car loan, they don't care. That takes you 7 years. They don't care. They
But I'm
they
saying
charging
with
you so much.
right,
that
but
if
with
you
a
pay,
poor,
you take it.
they're gonna make you go for the longer years.
Well, the only reason why you poor, you go for longer years because they make it affordable.
Right.
They
So
make
what-
the payment so cheap, but it takes it longer to pay off, and the interest so high.
Here's a great example. Now, just as a straight payment, so you borrow $10,000, but you're paying it off in 14 years. Look how much you pay back. $33,000.
Exactly.
Right? Now, if you look at the other one, because your interest is cheaper, we're paying the same $200. But we're able to pay it in 6 years in a month, and look how much we're paying. $14,000. That's double. Think about this is
It's
the
literally
painful amount. It's double. Double. So it's maybe work hard. This everyone that's being funny. This is why you got to strive and work very, very hard to have good credit, because you cannot and you do not. Yeah, that's good. You do not want to be in a position where your credit is poor and you're going to struggle, because everything costs more money. And just to look at it, if you buy a house for $100,000 and you got poor credit, and you say you're going to pay it over a 30-year period, you could wind up paying close to $300,000 to $400,000 on a house. Versus if you have good credit, it may be $200,000.
Right now, the housing market is crazy. It's no houses, so
It's not,
the
well,
houses that are available are really expensive, not in every demographic, but.
so this is the important.
Better about my.
Yeah, but this is, well, listen, but when it comes to credit, everything matters. House cost, everything matters. And, you know, I want to see my people do well and be able to manage their finances better. And credit is such an important thing. So, one of the things is to start being more vigilant, you need to know what your credit profile looks like. So you need to pull your credit report. Now, at the bottom right, the annualcreditreport.com is the best source to get your credit report from the three agencies. Do it once a year at no cost. My recommendation is that you pay and do it twice a year. Twice a year, because one of the things is there are things that pop up that may be on one, may not be on the other, or on the other. So you want to pull them and make sure everything is accurate and consistent. I pulled my credit report and they had 10 addresses on it. And this is for my entire life. And they don't need that. All they need is my current address. So I wrote back to them and said, here, I only live here. Please have these other ones. Because fraud can happen when there's information that's not necessary on your credit report. So you need to manage that and be very vigilant. This is work. That's why I said, you know, there's 3 guarantees and credit is the new one. Because if you don't have credit, it's in trouble. If you don't have credit, you're in trouble. If you have bad credit, you're in trouble. If you have good credit, you need to go and work and manage it from day one. So that's why it's important. Now, this is where I'm going to share a little personal story. So I recently moved back to my hometown, Delaware, 3 years ago. And when I came back, let's say the first year I came back, next thing I noticed that $500 every 2 weeks was being taken out of my paycheck. And I thought it was increased insurance or something. So this was, let's just say this was early November. By mid-November, I did receive a letter, and it was telling me why I was having this withdrawal from my account. Now, my own company, who they had to go to through ADP, garnished my wage. And so the company in New York, some kind of marshal, told me that I owed $10,000 for non-payment on the credit card, which was a Chase card. That's why I kind of laughed. I said, wait a minute, I work for Chase. So if I owe that kind of money, I wouldn't be working for them right now. Right. Or at least I would know about it.
Yeah.
I work for them. But
they don't have far to go get you. Right.
The major credit card unit for Chase is in Delaware. So look, and I work with them. So it was kind of interesting. But the point I'm making is that, you know,
was it really you though? Like, was it, or was
well, here's the story. So they were only the collection arm. They were not the ones who was going after me for this money. So he gave me the name of a law firm, blah, 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 blah. So he gave me the case number, everything, and I called them up, and they're the ones that confirmed, yeah, you owe this money, blah, 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 blah. So when you have an issue like this is what I did to resolve the issue. I sent them 2 letters. They ignored the first one. It was a cease and desist. They ignored that. So then how do you address something that you believe is not yours? So the next letter I sent them, the first thing I said is that I want a copy of the contract with my wet signature. You know, wet signature means original signature. I said, I need a copy of that. I also need a copy or a history of my payments. What's my payment history? Send me that. Because, and how you do it, you put it in writing and you mail it in certified. So there is a date of receipt, because they have 30 days to respond and produce this information. If they cannot produce this information within 30 days, guess what happens?
They got to take it off.
Exactly. So this was, I sent it out early December, and actually I forgot about it. So at the first of the year, next thing I know, I had 3 checks come home to me. And I'm like, oh, nice, a couple $1,000. And they said, oh, Mr. Wilson, you know, they didn't even say that I don't owe the money anymore. Basically, they said, well, we can't validate this, that, and you should go out and contact. I said, contact who? I don't even know who it is. And then about a week later, I got an email from my company stating that we reimbursing you the money that was taken out of your account. So it's always important to understand that you don't want to hide from the issue. You want to challenge the issue. There are laws that work in your favor. You need to learn these things because sometimes it's fraudulent transactions.
So like, do you think somebody got your information?
Oh, I have no idea, but one thing I do know is actually when I moved, I actually knew the couple that lived there or moved there, and he signed because remember he got served, and he signed. I said, why would you sign? And you're not me. So, oh, we're serving Mr. Wilson. Can you sign for this? So he validated that was me. Otherwise, if they never served anybody, they can't come after you. But this guy, whoever it was, signed for it. They even had a description of him, which definitely wasn't
It met you.
right. So these are the things that happen in life that you can't expect. So what you have to do is figure out how do I correct. Someone calls you up and say you owe money. I'm like, prove it.
Yeah.
I might. Let's say I did it. I forgot about it. So you need to.
I've learned, even if you think you might, I don't know, I might have did it, I may not, challenge them.
Yeah.
Challenge them, because believe it or not, a lot of companies do not keep records properly, and they can't give you the information, or a lot of companies bank on us not knowing.
Or challenging, or asking questions.
Right, or
Or
not
saying, oh, okay.
Or not even knowing the information.
They buy. Understand the credit card companies have already written off the loss if it
Right.
existed.
And that's
Right.
what my
So
lender
these-
told me when I was buying my house.
Yeah.
We're challenging that.
Yeah,
Because if they can't prove that, we're not worried about that right now.
Yeah, so they buy what they think is an opportunity. They may buy for $1,000, and if they call you up and say, "Hey, give me $2,000, we forget about it." They made a profit,
Right.
but you know they're not going to
But
take it.
sometimes they offer more than what you owe, but now it might be interest.
Well,
A
feel like
higher, you like, I don't even owe them.
it doesn't matter what they owe, what they talking about. If you
I mean,
feel you do
you
not,
didn't do
you're
it.
not responsible, then you got to take this.
But if you did do it,
Did do it, then I'm like, okay, well I did. Then I'm responsible, and I don't have a problem
you on
with
the
that.
payment plan.
Put me on the payment. I'm
I don't
responsible.
recall.
But until you
But-
prove it,
Right, but
Because
if you
again,
can prove it,
they-
I might
they-
help you.
When I did that with my student loans, I was like, well, send me where I signed that, because I know the systems is a little old and dated back there. So I'm like, well, show me where I said, jump this. Like,
all right, we're gonna get back on point. These are getting too deep for us right here.
No, that's not the truth. It's
We
the
don't-
same thing.
we-
Student loan debt is
we
something
don't
that
wanna-
impacts
we-
your credit and finances. And when you sign those promissory notes, it's the same exact thing, the same
It's the same
exact concept.
It's the
You
same.
have to be able to prove that I signed for this amount of money now in present day that you're coming after me. And people can relate to what? Student loan debt.
So let's get back.
They get
Remember I talked about the importance of pulling your credit history because the most important thing you have to do is go through it and try to see if there's any errors from personal information. I mean, it could be, my middle name is Jay, they could have it as E, and they have information for Darrin E. Wilson, and it's totally wrong. That's not me. So that could really damage your credit because they're trying to correlate it to your social security number. So that's why it's important to pull those reports frequently because they do make errors. Now understand, people input this. He may have had a bad argument with his wife, or she didn't get any sleep because the kids were yelling, and instead of putting a 2, she puts a 6. These things happen all the time. It is not an automated process. So, and there are no real good checks and balances. That's why so many people find errors in their credit report. And then you see the common errors. Personal information is always wrong. And as I said, if they got all these multiple addresses, get rid of them. Because it doesn't matter where you live, it's where you
Where you
currently
live now,
live
yeah.
and of course, account information, and that is another big thing, because they could have, what we've seen a lot is, since there are 3 agencies, some agencies have nothing regarding this issue, where the other 2 have information. Now, this issue could be something good for you, and it's like, how come you don't have it? You should have it. This could impact my credit score with you. So all this kind of stuff you want to address, and it's important. So here it is. It says, and one thing I disagree. It says file online report with the credit bureau. Don't waste your time with that. Everything must be in writing, and you need to have supporting documents to go along when you have something that you're trying to correct.
So mailing it in, like you
Mail
said,
it in.
certified.
Certified, and that's why I said there's that date, because this online reports, they get overwhelmed and inundated, and they don't necessarily respond as quickly, even though they are liable for it. But in writing, absolutely, it becomes a serious legal document at that
Well,
point.
online, don't they still have the 30-day window?
It's still, but we find that they don't respond as quickly as a letter. A letter is more impactful. Online, you're just, it could be thousands of them. Your letter, not as many. So one of the things a lot of people is that a lot of people have issues. They don't have credit, and they try to get credit. Now, there's two things at the bottom I'm totally against. Never co-sign for anybody to help them with their credit, because it's not really going to help them, and it could hurt you if they say, "Hey, I'm not paying for it." Authorized signer, another thing. You don't authorize with nobody. Now, if they need
children,
nobody. I haven't done it for my son. No. What you do though is you help them build it. Secure
so you don't have to do that.
Yes. So secure credit. What is that? It can be enabling. Co-signing can be, it can be, but it's also a hindrance because you're not helping them. So what you want to do, if they're young and have not established credit, get a secure card for temporary purposes. The only thing, it's nothing wrong with secure cards. It teaches them how to start managing their debt. Also, as long as you use a secure card that's free, there's some ones that they charge you an annual fee. I'm like, no, not necessary. There are a lot of free ones that you can use. And then Chase and other major financial institutions are offering different types of credit cards to help people. We just came out with a new one to help people who are college students or young high school students, help them really learn how to manage it, not giving you an extreme credit limit to get you in debt. Because when I was in college, they gave us cards like it wasn't nothing. I had a credit card offering in the mail every day. And guess how I managed it? You listen. I ate well.
Well, what was the story then? What story was it?
But what happened when I graduated, my credit score was abominable. I don't want to talk about that. So we want to make sure that we're very active in our kids' life and teach them. We have to pay it forward. So, okay, I don't know if that's good for you guys to see.
Too many credit inquiries?
Yes. Now, I don't know if everybody understands, they hear about it, hard and soft inquiries. Now, just make it very simple. A hard hit or inquiry is something you authorize, meaning that you're trying to get an apartment, you're trying to buy a car, you authorize and you sign off to allow them to pull your credit. So it's going to be a hard hit against your credit score. And that could be 5 points, it could be 8 points. It's a hard hit. Now, the inverse of that, and the ones I don't like, is the soft ones. Because the soft ones, we don't authorize. For example, I get Discover Card pre-approved credit card all the time.
Oh, is that what that's happening?
And they may only pull it one time, but they do a soft inquiry to see what is your credit profile.
How do they do that without your permission?
Because once you're in the Experian, Equifax, TransUnion loop, they got your information.
Exactly. See, pre-approval for mortgages, pre-approval for
information
to each other.
Everybody makes money off of who you are as an individual in this
It's
country.
passing us around.
So just like here it is, unsolicited, here it is right in the middle, read that, unsolicited, pre-approval, offers from credit card company. So when you get too many of these, understand, you get one of these, it's usually like a 1-point hit against your credit score. Usually that comes back up in a month, usually. But let's say you're getting 5 and 6 of them, it becomes an issue. So you don't want a lot of those. The hard ones you understand because you're trying to achieve something. Right. You're giving authorization. But the soft ones, we have no control. I always think this is something we need to take to Congress and deal with. But You know, this is why we have councilmen, we have all these, it works against you. But this is life as it is right now. We just want you to recognize it and understand it. So if you're tracking your credit score and you're seeing a drop, you want to know why.
Yeah.
You want to know why. And one of the great things that are available are like through banks. It's like Chase has credit journey. And I think we use Experian, and they give you a credit score and they give you history about your credit. Other banks do the same thing. Even companies like Credit Sesame and those, I don't like those because they're all there about selling something, but they give you a credit score and they can give you some information about who's trying to get information about you. So they're good to have, and they give you a credit score that's probably fairly accurate within 5 or 7 points. So I would recommend whoever you bank with, see what type of credit, well, I call it credit journey, to see what type of credit reporting they have available to you. It's usually free.
And right on your online and mobile banking.
That's where it comes from. That's where Chase has. We probably were the leader in that, but I'm not gonna talk about brag about my company in that regard. I'm just saying, you know, you want to bank with somebody that's doing something for you. So now here's a little test. When you apply for a credit card at your favorite store, is that a hard or soft hit? What's the answer?
A hard hit.
See, oh, there's the answer. Okay. Credit card company checks your credit and then sends you pre-approved credit card offer in the mail. What happens? Excellent. And the last one, I don't know why this thing does that.
And the employer checks your credit as part of a background check. I would say that better be a soft. You better not be making my score drop.
Yeah, what's good about that is that you're actually giving them authorization, but it's still only considered a soft hit because they don't need a deep dive into it. Because one of the things in the country now is that it's very unlikely that you will be denied a job because of poor credit. But it still depends on what your job you're
I was gonna say, does it depend on where you work at? Because I mean,
and what position you're.
Think about it. You work for a company. Did they ask you for your credit history?
no, but
I work for the same one, and they didn't ask for me. But there's certain roles within the bank. Let's say, for example,
you teach credit. What if you had a score of 100 and you owed $1 million in credit? Do you think you will be teaching this?
But I mean, if I think about it from a business side, if I'm hiring a CEO, I want to know their credit history. And I want to know how they manage. I of course, I don't know not what about.
You can't manage your money. How can you manage this one?
All I'm saying is there are jobs where there's more of a deep dive into your background. It's something we have wealth. Now, wealth does it a little different. They have what they call U4. U4 contains a lot when it comes to securities, but it also pulls your credit as well. So it's just an avenue to get that information. Anyway, hey, student loans, hard hit, right? We all know about those, so good luck with student loans.
If anybody wants to take mine.
So here's something that I had a really long conversation today. And we talked about understanding credit reports, security locks, and freezes. So hopefully, I'm just reading a question. There are no restrictions that I know of, but like I said, it really comes down to what type of job you're applying for, and is the organization concerned about that? Is it a policy of theirs? In today's world, most of them do not. But again, you know, you may work for certain government entities and they're going, yes, that's an issue.
Yeah, that's an issue.
Even state issues. So it's really predicated on the job that you're applying for.
So it should be a policy. It should definitely be.
Now, I have a question. Why would we freeze our credit?
So
What are the main reasons why we would freeze access to our credit?
Somebody has taken your identity and you want to freeze it so that no one else can touch it. I know that's a reason.
Well, that's one. You want to repair what could be some fraudulent transactions. But I guess that's not even the largest reason. The largest reason is if you're planning on making a major purchase, and let's look at buying a home. You worked hard to get your credit score up to 800. Just use an example. You don't want anybody to come in and doing any hard hits or soft hits to drop your score when you're about to go to some financial organization to apply for a loan. So what you do is when you freeze it, no one can go in and inquire about you. So the lender will say, guess what? I don't have access to your credit history. I need it to determine whether or not you qualify. Then you give them, just them, access. And then once you get approved, then you can go ahead and unfreeze your credit score. So that has a lot to do. Fraudulent activity is probably number 2, but they're very, very close. A lot of people don't, but they probably should use it more frequently when there is an issue about some fraud. You should scroll down because you can't see it. So, why to use and all these other questions, what's the difference? And utilizing credit monitoring, high wow, what is extra protection? All these things are very important to go to understand and to utilize, and to contact your credit agency and have that conversation with them to see if they have any policies or any issues that may be, strenuous that will help you or could hinder you in terms of freezing and locking your credit. And for the most part, it's not. I think the length of time, the longest is 5 years, but I don't know why you would do it that long, because it will work against you as well. But that's a very good point. Based upon anti-discrimination laws is why credit is not a factor. Because, look, in the Black community, we were underbanked, we're underserved, we don't have access to certain resources in which will help us build good quality credit. We're underpaid for the most part. I mean, look at Delaware, median household income is $30,000.
For the entire state.
Yes, it's very difficult to build quality credit when your pay is so low with all the other expenses and responsibilities you have. So that's why it's good, so they can't discriminate against you, because it was used that way. It was used that way because a lot of us had, not necessarily bad, but low credit. And they use that, one, as an identifier, and then 2, to deny you employment. So we just, we're happy that they don't do that. But again, certain jobs, especially the ones that pay a lot more, definitely will pull your credit. So with that being said, that's the end of my presentation. We will take questions that you may have. I may try to share some other little tidbits, but I think I pretty much used them all up for tonight. But please, ask the question. Ask the question. Why I'm here, ask the question.
Well, I have a question, and I'm a mom, so I'm thinking about it.
Okay.
I got it.
I'll get nothing for free. No, thank you. Go ahead.
So, okay, what are some tips and some things that we can do to, number 1, create healthy credit in our young kids and our youth now? And as a parent, what are some things you can do right now to help your child have good credit or better credit, or even have an understanding of credit and what it means to have it?
Well, let's do this first. In my opinion, this is what I did. And number 1, depending on the age of your child, you should give them a job.
Okay.
And you pay them.
Pay each other.
3 times.
You pay them. Now, understand, we want to build understanding of the value of work. We want to build the understanding of value of savings. And then you can start teaching them the other principles, and credit will be one, but you don't need to get into credit until they get a little older. Probably when a freshman in high school is when you really should start having that sit-down conversation. But back to the point. So what freshman in what? High school, yes, trying to have that conversation, but it helps you. She needs to get a job during the summer, and this is where you can start have her open up her own account and start understanding how things work financially. But the younger ones, I say, give them a job and pay them. Pay them by the hour. I don't care how you give them a chore. You know how some people, they just get, what's that you call it, allowance? I don't even know what that was. I've never heard of it. Allowance, what's that?
Right.
No, I was supposed to take out the trash, sweep out front, but you got to give them that job that they do it consistently. If it's once a week or if it's every day, and then you pay them. I don't care, maybe only $2 or $3, but you pay them. But this is what you do. Let's say you give them a job and they do the job, and you say, I'm gonna pay you $5, but there's something called tax. So now I'm gonna pay you $4. But I also want you to understand savings. So I'm gonna pay you $3. And what you do is you can take that money and set it aside. But you're now teaching them how the real world works and how to say savings is important and show them that, like the tax, you can keep doing whatever you want. But the savings, you should sit aside and put it somewhere and say, listen, I'm saving this for you. But you need to start teaching them, and we need to teach them the value of money. We need to teach them what buying power means. So our kids are prepared. You don't want to go to school not understanding these things, not understanding principal and interest, which is a thing that I did seminars for college students over the summer, and they didn't really grasp the difference between principal and interest.
Which means they didn't learn it in high school.
They didn't learn it in college because these.
Well, I mean, but I would think if you knew it in high school, you would definitely learn it in college, but.
And these were college students from all over the country. They were not getting the concept. They were not getting the concept. So we need to be more proactive with our children and preparing them. So work is essential because they're gonna have to. Unless you got silver spoon, you hit the lottery.
Right.
Even if they do, you should still work, but do what you like to do. But teach them young, and that teaches them responsibility. So part of that job is every morning you got to get up and make your bed, and then you got to do this and you got to do that, and this is a checklist. Was it done? Was it done? And that has to be how you get paid. If you don't do your job, guess what?
You don't get paid.
You don't get paid. There you go.
My daughter knows when day I get paid.
Yeah.
And she know how much money she gonna get, but I trickle. I may not do a lot of talking because you didn't do your chore. Okay, that means you're not getting paid for it. So
And you got to treat it like a man. You got to pay her what she earns, and then if she wants something extra,
You gotta
You
do
gotta
extra,
buy it.
just like your job, overtime.
no, say you got to buy it.
Yeah.
So we've been saving money for you. You got to take it out of the savings that we generate. Now, if you don't have the money to pay for it, now you start teaching about credit.
Cause now you owe me, I'll buy it for you,
Yeah.
you pay me
So
back,
there you go. And if you don't pay me back on time, it's
Yeah.
going to cost you more money.
right?
So these are the
And then I'm not gonna
tools.
borrow.
Oh, I get her too. And
Yeah.
we toured them to her last week. So I don't know how much credit I really want to give you.
Yeah, and it's like, you gotta understand, if they didn't do the chore, they didn't come to work. They didn't come to work that day. And a lot of people are paid by the hour, so you know what that means? You don't get paid. So if you earn $5 a week and you miss a day, you're down to 4. And this is before tax and before savings. So that's how you have to treat it, and that's how you have to educate. And I think it works very, very well.
And what about authorized users? What you think is a good age to add?
None.
Child? No, so you don't think to add one?
No, it's not necessary.
So
As
that
soon as-
doesn't
as
actually
soon
use
as
their
it-
credit score?
I said, not really, because
I
again,
mean, I can control her stuff, but that's the only, you know what I mean?
you're not teaching because it doesn't really impact their credit score. So you want them to be independent. So you need to start, that's why I said, as soon as they reach that age where they start working, you gotta start teaching them the importance of saving. You can get a credit card at some point, even if it's a secure card. You're teaching them. You don't need to be authorized for nothing. It doesn't do any good. And plus it puts you
So
at
it
risk.
doesn't actually, well, I mean, listen,
It
also,
puts,
if this is your child, like your daughter, she doesn't have access to any information. She doesn't even know she's an authorized user. This is something that you're doing on the back end for her. I've heard people say that they do it for their kids that are a lot smaller, so that's why I'm asking.
do the kids pay the bills or the parent?
It doesn't matter if you're
It
trying to build
doesn't
your credit for your child, and my
You're-
child is 5
you're
years
not-
old, and I add them on as an
You're not
authorized
gonna build
user,
it.
they
You're not
don't
gonna
even know
build
what's going
You're not
on.
gonna build any credit, especially somewhere at that.
So you can't build credit that small?
It's-
Cause I mean, what about kids that are self-employed and have jobs at that age?
They don't
What's the
necessarily
difference?
got credit. And listen, one of the things I can tell you is that
Like child
when,
stores.
here's an example. We had
That credit's still
a
good.
woman come into the bank and
It's not
said,
a lot of money to start out.
So is that
Well, they don't
law
give
that
it
your
to them.
credit
Listen-
can't start
listen-
until 18?
listen to what I'm telling you. We had a woman come into the bank and her son is a model. He's 3 years old.
Okay.
Anybody who is a youth like that will not get paid directly. If you're working for any quality, they're going to say, you need to put this money in a trust.
Right.
He is not mentally capable of managing the money. This is where abuse has come through, where you hear child actors are broke because the parents have access to the money to do whatever they want, yada, 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 yada. So you want to have that money go into a trust.
But it's the parent that still has to make that decision to put it in a trust.
No.
Because I mean, the child was free.
Hear me out. The business who pays that child mandated that they put it in a trust. So she came in and said, oh, I need to set up a trust. And some people, I don't know who they talked to, really didn't know how to handle it. I said, well, we got UGMAs, UTMAs, and we got other types. What do you want? So that's how you handle it. But the business that pays that child for the work done, they will not cut a check to the parent. They don't want a check to go into that trust. Now, still, I understand the parent still has kind of access to it, but it's a legal document that she can. So, because they are the trustee. So that's why I said we got to follow the right principles and understand how it works. I mean, all those things sound nice and good, but at the end of the day, are you really teaching someone something? No, you're not.
I understand
you're just hoping that they're going to build credit, but.
No one said that you're not going to teach it too. I'm just asking, is that another vehicle in order to help your child?
At the end of the day, who's responsible? That's the one that's going to have the credit impact, good or bad. You. Just because they're a signer.
People use kids' Social Security cards at early ages, so how can they? There's no law set for the credit bureau to say that because you're this age you can't have credit. Is that true?
I don't know, honestly. I've never seen someone under.
Because we've heard of those stories where people get stuff in the kid's name. Well, so if you can get stuff in the kid's name, it will behoove me that you would be able to do that with credit.
Organizations don't care. They're not really tracking.
I would say, but it's not legal.
Yeah, it's not legal to do that, and they're not really tracking it. They care.
But we're not saying this to go mess their credit up.
But if an adult is associated with it, the adult is ultimately responsible.
Right.
So they don't care because they see you, because if this doesn't happen, it's going to fall on you. That's why cosign is not necessary to today's times, because there's too many other ways to help a child come up than you putting yourself at risk, and it doesn't work.
So you're saying don't do it, but the reality is you still can do it. You're suggesting that it's not something to do, but you can do it, and that was my question. You can do it, because I know people that do it.
Why? That's the question. I don't care. Just because you can do something, there's always a why.
Yeah, somebody had me on as an authorized user, and it worked in my favor very well.
It rarely does, because it usually doesn't really build credit at all.
Well, it helped me. So how does it? So it doesn't work. If you add someone on, it doesn't mean.
How old were you when you were at
it? In my adult years.
It typically doesn't help. Now, I don't know how your situation may have changed, but it doesn't have a significant impact on the signer, not the signee. We gotta get it correct. It doesn't really have an impact on them. So we got a new message there. Can you pull that down? I personally, I'm not in favor of it, but if the people want to do it, I tell them not to. I advise against it because, like I said, there's tons and tons of ways to help improve yourself without utilizing and putting somebody at risk. That's not a long question.
Yeah, that's Samantha. Hey, Samantha, that's one of our board members.
All right, we could probably take the recording off of this. But what is she saying?
Time.
Okay, but it's not anything pertaining to credit.
Just say, can you share how to? Oh, she already said that. Can you share how to freeze your credit? Did you say how to freeze it?
No.
Well, no, I didn't say how, because you just have to contact the credit agencies, and you put that request in with them, and they usually do it for you. That's how you would lock it and unlock it too. That's the only way you could do it. You shouldn't just. I don't think it's an online process that I'm aware of for them. It's usually best to just have a phone call and tell them what you want to do, and they can also help advise you how to best go about managing when your credit is frozen. So I would rely on their expertise, because that's what they deal with every day.
Well, thank you.
And it says, Darrin, this has been a great presentation on the fundamentals of wealth building. You made it easy to understand.
Just put the check in the mail.
Thank you. I don't have any more questions.
Yeah.
Thank you so much for your time, for your expertise, your energy. A lot of gems were dropped tonight. The great thing about live is if there's anything you missed, you can always go back and replay it. We are going to saved alive and then posted on our pages as well for easy access to you. Please feel free to visit our website at www.pifngroup.com. We are a nonprofit organization, so please feel free to make a donation to us. No donation is too big or too small. We do want to continue to bring you great events like this. Next week, we are going to be going live about education with Senator Elizabeth Tizzy Lockman. So please just stay up with us, stay connected so that you can stay abreast of everything we have going on. Kendra, do you have any closing?
No, no closing remarks. Just remember, wealth building is generational, so let's do this together. I learned a lot. I'm not there all the way either, so let's all learn together and do better together.
Thank you. And Darrin, you have any last?
No, not at all. Hopefully I get invited back so I can go over.
We're doing part two, so.
My budgeting and saving, so we can look at how we can get started on our journey becoming financially free.
Yeah, so we're going to do wealth building in the Black community part
We do it next
two.
month. We do it next month sometime.
So stay tuned.
Right. Hopefully we can get this in person. This will be good in person, I think.
What are you doing with education? What are you doing?
So it is, I'll let her finish her thoughts.
I gotta go to dinner.
So we're going live on the psychoeconomics and
Socio